Changes in volatility can have an even greater effect on option prices than changes in the stock's movement. And that's why you need to master volatility and how to understand it on a deeper level so you can get stupid rich and use it to your advantage rather than having it take advantage of you. In this video that you'll be watching to the end, we'll explore the concept of volatility and how it impacts your profits when trading small and large amounts of money. After getting educated on different measurements of volatility and best practices on flowing with it, I'll show you cheap option trading strategies you can implement in the market immediately. Something you need to not fear after you take some notes, and of course, smash that like button for Uncle Henry, is going to be volatility. Volatility is a natural part of the financial markets. Markets are inherently volatile and price movements can be influenced by a variety of factors such as economic data releases, geopolitical events, and changes in investor sentiment. However, this volatility is what creates opportunity, and without volatility, there won't be any opportunity. So volatility is actually a good thing. Volatility refers to the degree of fluctuation in an asset's price over time. Higher volatility means bigger price swings, which can be a good or it could also be a bad thing depending on your position in an option. When I worked on Wall Street, a rich trader told me volatility is his friend. He loves volatility because he flows with it and he spots more inefficiencies in the market. He successfully navigates the market and he ends up coming out ahead because of all this volatility is actually presenting him some opportunities. Volatility is a key component of how you want to flow your capital. Volatility is an important concept in option trading because it impacts the value of option contracts. So if you understand it, you can take advantage of it rather than having it take advantage of you. Volatility can be measured using several different metrics. The most common measure of volatility in option trading is implied volatility, which is the market's estimate of how much an asset's price is likely to fluctuate in the future. Implied volatility is like the weather forecast. It's always changing and you never know for sure what's going to happen next. One day it might be calm and sunny, the day is amazing, has low implied volatility, and the next day it could experience a lot of winds and that could end up not being the best weather. And that's exactly what happens with implied volatility as well. But there are plenty of signs which can warn you to prepare ahead of time for what's to come. So even when implied volatility is changing, you can still take advantage of it. And when it's higher, you can understand that option selling is better. And when it's really low, then you can pretty much say that option buying is better. Another commonly used measure of volatility is historical volatility, which is a measure of how much an asset's price has fluctuated over a specific time period in the past. So rather than implied volatility being what's going to happen in the future, historical volatility, as the name suggests, is what is actually happening in the past. It could be 30 days, 60 days, or 90 days. Traders and investors use these measures of volatility to help them make decisions about when to buy or when to sell option contracts and which strike price to choose. Options with high implied volatility will be more expensive, hence why it's better to sell, while options with low implied volatility will be a lot cheaper and they're probably a better bargain for you to buy. Perhaps the biggest opportunity is when you buy an option that has low volatility, but then the market increases, causing that option to shoot up in value, even if the stock does not shoot up in value. You can make a lot of money if you're buying low and selling high, and that does not mean price fluctuation. It could just mean simply a spike in volatility. Buying when volatility is low and selling when volatility is high. Or selling when volatility is high and just waiting for that option to decay and then collect all of that premium, keep it, and do it again. Historical volatility can prove insights into how much an asset's price is likely to move in the future. And if it's a lot different than what the market is pricing in for implied volatility, then you potentially have an opportunity on your hands to look further into because there's a big discrepancy. You want to figure out, why is there a discrepancy? Is there a potential buying opportunity or is there a potential selling opportunity? Changes in volatility can have an even greater effect on option prices than changes in the underlying asset's price. Option prices are composed of two main components: intrinsic value and extrinsic value. Intrinsic value is the amount by which an option is in the money, or the difference between the option strike price and the current market price of their underlying asset. Extrinsic value, also known as time value, is the amount of additional value that an option is beyond its intrinsic value. So, extrinsic value is impacted by several factors, including time remaining until expiration, and critically, the level of volatility. Imagine this, you're buying a car. The intrinsic value of the car is its actual value as determined by its make, its model, its year, and the condition the car is in. This is similar to the intrinsic value of an option contract, which is the amount by which the option is in the money based on the current market price of the underlying asset. Now, imagine the car you're buying has a special feature that makes it more valuable, such as an advanced engine or custom wheels, leather seats, or maybe even historical significance, unique paints, or other factors. You know, I was actually watching Fast and Furious, and Paul Walker, who was one of the stars of the Fast and Furious movie franchise, passed away in a car crash in 2013 in a Toyota Supra. The auction was a very emotional moment for many fans and franchisees, and the car ended up actually selling for a staggering $550,000. And that's because the car had sentimental value because it was tied to Paul Walker. The buyer was a car collector and a fan of the Fast and Furious franchise. So this added value is very similar to the extrinsic value of an option contract, which is the amount of additional value that the option has beyond its intrinsic value. In the case of the car, the added feature or sentimental value would be similar to the time value of the option, which is impacted by factors such as time remaining until expiration, volatility, and interest rates, but can also be upcoming earnings events. The good news about the extrinsic value is its value to option traders. If you choose the right strategy and direction, extrinsic value actually works in your favor significantly. Now, I want to discuss some strategies for trading in high or low volatility markets, such as straddles and strangles. But the most common question, literally, that I get on my YouTube channel as well as my Discord community is position sizing. And one important consideration is how much of your portfolio you want to allocate to the straddle position before I go into it. As with any investment, it's generally a very good idea to limit your risk by not including too much of your capital in any one position. Now, a typical size for me is 2 to 5% of your portfolio. However, I want you to think about the extremes. If you have $1,000, does it really matter if you put 50% of your portfolio into one position? No, not really. Now think about it this way. If you had $1 million, do you want to put 5% or 50,000 in a position? Well, probably not. You probably want to diversify even more and put $20,000 into your position. So I always like to think about extremes because when I got my finance education, my economics education, I was learning about different theories in the market, and you always think about extremes to see if anything can go wrong. So if you have a very small portfolio, then it's okay to put more into that position. You can experience volatility and you don't really need as much diversification because, well, anyone can make $1,000. If you don't have $1,000, you can absolutely go work for it in a first world country and get that in like a week or two, or even less than that. Okay, but if you have $1 million, it is very hard to work for that and get $1 million. In fact, pretty much takes a whole lifetime to save up $1 million. In which case, if you're trading a higher amount of money, you want to have even more smaller positions and diversify yourself better. Whereas a small portfolio does not need to diversify themselves as much as a bigger portfolio does. And that's why I say a rule of thumb is having about 2 to 10% of your money in any one position. But what exactly is it? Is it 2 or 10? Well, that depends on your portfolio. I would say the bigger portfolio you have, the lower you want to get. And the smaller portfolio you have, you can even push it up to 25% of your entire capital in one single position, because that's only $250 if you have $1,000. I always think about extremes in terms of how I want to manage my risk. And in terms of risk management, it's really important to have a plan in place to manage your risk. You want to come up with that plan ahead of time. You don't want to think about what the plan is when you're already in a trade. With a straddle, your maximum loss is the premium that you pay for the option. So one way to manage your risk is by not putting too much money into a straddle to begin with, and just by simply putting some money into a straddle on one position and then on a different position. You can also consider using other hedging strategies such as selling calls or put options at different strike prices to reduce the cost of the straddle. And in fact, you can basically turn a straddle into an iron condor if you choose. I'm going to be showing you an example in just a minute. But before I show you an example, I also want to tell you a story, because I used to work at Goldman Sachs and I met many CEOs, I met many Hollywood actors, I met a lot of people that have net worth between 30 million all the way up to the billionaire status. And there was actually a CEO that I met who was a pretty new CEO, and he had accumulated $50 million in a stock. Now I want to tell you this story because it really paints the picture that no one really knows what's going to happen. And this CEO was pretty stubborn, and the financial advisor was telling him, like, you should probably diversify your stock position because, being the CEO, he gets granted a lot of stock. So over just 2 years, he was a new CEO. He worked for 2 years. He already had $50 million worth of the company stock. Now, the CEO was very stubborn. He did not want to sell his stock. He was like, what can we do? How can we make money? But the financial advisor was basically telling him, you should diversify, you should sell a part of your stock. And he was very reluctant to do that. He's like, well, I'm the CEO, this is a good stock, etc. And guess what? He ended up listening to the financial advisor, which was smart for him. And then in the following 6 months, the stock ended up actually plummeting 37%. So the financial advisor ended up being correct on diversifying. And by the way, they all say diversify. All the financial advisors, in fact, if you talk to them, they'll just say, put your money in an index fund. So I'm not a fan of financial advisors by no means, but I am a fan of diversification. I think that's really smart. And this story of the CEO who literally had $50 million, that was an insane amount of money. He could just totally retire and do nothing for the rest of his life and be completely fine. He wanted to take more risk. He did not want to justify, diversifying. And he thought that he knew that selling the shares was a bad idea. And oh boy, was he wrong. The CEO was very hesitant and he was very attached to the company, and he didn't want to miss out on any future gains. However, after having some discussion with the financial advisor, he kind of realized, well, maybe I should diversify. In the following 6 months, the stock tanked over 37%. So I realized that the biggest mistake is overconfidence and not managing a position size correctly. And even a CEO of an S&P 500 company was wrong about his own stock. He was literally wrong about his own stock. So if a CEO doesn't know where his company stock is heading, do you think that you should have about 50% of your money in a single stock if you have more than $10,000? It also kind of reminds me of a different client that I had who had $45 million in Tesla stock, gave me a call, set up a consultation. He was asking me how he should basically move forward. Should he keep buying call options? And I'm like, buying call options? You have $45 million of this stock and you want to buy more call options on Tesla? I told them you should do the opposite. You should sell covered calls, you should get out of this position, and you should cut it up. I was kind of having a similar opinion as the other financial advisor that I used to work with. Now, again, I'm not a huge fan of financial advisors. I think that they usually don't do a whole lot of work. They just put you in index funds. They say diversify, and then they don't actually have a plan. But when it comes to how I think about a portfolio, obviously diversifying makes sense, but you want to diversify into option positions because options is where the money's at. That's how I became a millionaire. That's why I teach people option trading in my Discord community, which again, you can always get a link in the description to join that. But back to this client who had $45 million asking me, do I buy more call options? I was kind of just scratching my head. I'm like, this guy is crazy. I told him straight up, I'm not gonna lie to you. You should not buy call options. What are you thinking, man? You can retire now on 45 million. You could be fine. But if you lose a significant part of this 45 million, your lifestyle will change. The money that you're used to having right now and the cash flow that you're getting is gonna be very different if Tesla ends up falling 50%. And mind you, this was when Tesla was at its very peak. And he did not listen to me. Ended up just having a quick consultation, did not end up joining the Discord community. That was totally fine with me. 6 months later, Tesla ends up tanking a whole lot, and actually he did end up buying call options, which I told him not to do. His portfolio went from 45 million to under 20 million. He had like $18 million. And he was really stressed. And I told him, I'm like, man, I don't want to say I told you so because I'm not like that, but just please diversify. Let's get rid of a lot of your position. Let's start getting into the positions that I'm in. Let's start doing covered calls. Let's start doing some safer strategies. Let's start focusing on income. Let's stop being in the casino, okay? Let's stop buying options. Let's stop being all in on one stock. Let's actually spread our money across many different sectors, many different stocks, and then let's actually have a longer term perspective by using options for income and not for gambling. Ended up doing that, one of the happiest people in my Discord now, but still, I just want to point out that managing your risk is like literally the most important thing. Please don't have more than 50% of your money in any one position. If you have a larger amount of money, please consider having many, many small positions. So now I want to show you my screen on how to actually get into straddles and how to potentially turn a straddle into an iron condor if you need to take advantage of volatility. All right, let's take a look at Tesla. Tesla is a really good candidate for a straddle. and an iron condor. We're gonna go over both examples. The reason why Tesla is so good is because this stock is all over the place, has a lot of volatility. As you can see, the stock always kind of has a very high peak where it goes up by, over 20%, drops back down, and then, again, it'll peak over 20% and it'll drop back down. And this was a sustained drawdown. And then from here, the stock literally doubled. So like, it's always having peaks and valleys, which is pretty good because that means the stock is basically reaching, all-time highs, then crashing lower. I mean, it's just all over the place, which means that it's a great candidate for a straddle, okay? Really, what you want to look for when you do a straddle or you're buying an iron condor, you literally just want to find the craziest stock. The crazier the stock, the better, because then you're taking advantage of volatility. It's literally what you're trying to take advantage of. So a stable stock would not be a good stock to use this strategy on, but a stock like Tesla is great. So currently Tesla is at $209 per share. Let's go to trade Tesla options. So check it out. We're gonna go out at least about 60 to 90 days, okay? So here's 60, here's 90 days. I'm gonna go out 90 days. And that's because I want enough time for the stock to go wild in one direction or the other. As you saw, although this stock is reaching, bigger peaks and then many valleys, it does take some time for a story to play out, whether that's job cuts, whether that's a new earnings release, good or bad. It does take some time for a stock to have a significant move one way or the other. So what I'm going to do right now is, currently the stock is $209. I'm actually going to buy a call and buy a put. So if I end up buying a call, then I end up buying a put. This is an example of a straddle. So I can actually buy the 210 straddle right now. So as you can see here, this is a long straddle position and you're basically benefiting when the stock goes wild in one direction or the other. Now notice the maximum loss is very high, and in just a moment I'm going to show you an iron condor because they are way cheaper than actually buying a long straddle. A long straddle is pretty expensive because, well, you're just buying a call and you're buying a put. You're not really using anything else to subsidize your cost, lower your cost. It's fairly expensive. So you're buying two options. Yes, it's going to be expensive. However, check it out. Your break even on the bottom is 154. Can Tesla go below 154? Well, we really don't know. We've seen this stock do crazier things. Now on the upside, 265, can it go higher than 265? You're going to start profiting. Can that happen? Well, we also don't know. This stock is very crazy. So it can go either way. Now, for you to reduce this max loss, okay, so this is a long straddle that's kind of expensive. For you to reduce this cost, now you can go to sell call, okay? You can actually sell, let's say we're at the 210, we can sell the 220. So when I sell this 220 right here, it's going to basically cut off my gain by a lot. Like I can't make any more money than 220. However, my max loss has significantly from 5,500 decreased to 3,153. Now this is a pretty interesting order because as you can see here, you're basically just trying to bet if the stock will go down at this point with this position. But we're not done yet, okay? What we're gonna do is we're also going to sell a put option, okay? So now I'm going to sell a put option. I also want a gap of $10. This is to keep the iron condor pretty stable. Basically, one side is going to be $1,000 gap and the other one is also going to be $1,000 gap. So I want to make sure that the difference is also 10. That just makes the iron condor look prettier and nicer and also easier to pretty much track. So here you can see that you need Tesla to move to make some money, and it's a lot less money. However, your break even is now literally 200. So instead of being 154 all the way down, the stock just has to move below 200. Can that happen? Absolutely. It can absolutely happen. And then on the upside, can it go beyond 220? And again, that's a yes. So in the next 90 days, is this stock going to have a significant breakout? Most likely. Or is this stock going to not sustain its current momentum and go down a lot? Yes, that's also very possible. So that's why the maximum loss here is very huge and the maximum profit is not that big. It's because there's a very high likelihood of the stock ending up here or here. And again, this might not look attractive to some people because some people are like, well, I want my risk to reward ratio to be 5-to-1. Well, that's fine. Let's say that you're risking $20 to make 100. That's cool. But what if I said that you only win 1 out of 100 times? So that wouldn't be cool, right? You're winning 1 out of 100 times. Yeah, you have a 5-to-1 ratio, but It only happens 1 out of 100 times. So your actual return is something super tiny and small. You're actually going to end up being a loser. So with this position, say that you can win 100 times and then you can lose 10 times, right? So 10-to-1 ratio, okay? Here you can win, say 6,700, and then you lose twice, you lose about $2,000. You come out ahead with $4,700. That's why actually collecting a small profit isn't always that bad. People don't really understand that it's not really about the risk to reward, it's how many times you can win multiplied by that risk to reward. What is your chances of winning multiplied by the risk to reward ratio? So if your risk to reward ratio is $1 and you're risking 100, but you can win that literally 10,000 times and lose once, I'll take that bet all day, right? So be careful when you use iron condors and straddles, but I think this is a fantastic position for taking advantage of volatility. If you want to run your trades by me, watch how I trade every Monday and Wednesday, get access to me basically 24/7, you can always apply for the link in the description for my Discord community where I will coach you and make sure that you get consistent with your weekly income trading options.